Lynch Company had a net deferred tax asset of $69,020 at the beginning of the year, representing a net deductible temporary difference of $203,000. That's taxed at 34%. During the year, Lynch reported pre-tax book income of $812,000. Included in the computation were favorable temporary differences of $23,000 and unfavorable temporary differences of $51,500. At the beginning of the year, Congress reduced the corporate tax rate to 21%. Lynch's deferred income tax expense or benefit for the current year would be one of the four choices: net deferred tax benefit of $5,985, a net deferred tax expense of the same amount, or a net deferred tax benefit of $32,375, or a deferred tax expense of $20,405. The correct response is a net deferred tax expense of $20,405. The net deferred tax benefit for the current year is $5,985. Now we calculate that by taking the $23,000 and subtracting $51,500, and then taking that difference by 21%. The beginning balance in the deferred tax asset account must be adjusted downward to reflect the change in the tax rate by 13 percentage points. So take $203,000 times 13%. Then that's a reduction in the deferred tax asset. So the net adjustment is a net deferred tax expense of $20,405. Tar Heel Corporation reported pre-tax book income of $1,038,000. During the current year, the net reserve for warranties increased by $101,900. In addition, tax depreciation exceeded book depreciation by $209,500. Finally, Tar Heel subtracted a dividends received deduction of $57,600 in computing its current year taxable income. Tar Heel's accounting effective tax rate is one of the four choices. It's either 21%, 19.83%, 18.67%, or 17.5%. And we see that the correct answer is 19.83%. The effective tax rate is the hypothetical tax rate, so 21%, adjusted for the tax cost or benefit from permanent differences. In this example, the dividends received deduction reduces the effective tax rate by 1.17%. So we would take $57,600 times 21% and divide that by $1,038,000, the pre-tax book income amount. That's $1,038,000. Green Corporation reported pre-tax book income of $1,006,000. During the current year, the net reserve for warranties increased by $50,300. In addition, tax depreciation exceeded book depreciation by $101,500. Finally, Green subtracted a dividends receivable deduction of $25,150 in computing its current year taxable income. Green's cash tax rate is one of the four percentages you see there. Okay, now the background noise is my dog sort of groaning, making some noises as she sleeps. We see that the answer is 19.41%. The cash tax rate is the taxes payable divided by pre-tax book income. So Green's taxable income is $929,650. That's $1,006,000 plus $50,300 minus $101,500 minus $25,150. Taxes payable on taxes income is $195,227. The cash tax rate then becomes 19.41%. You take $195,227 that we just calculated, and you divide it by the pre-tax book income of $1,006,000. Which of the following statements concerning the classification of deferred tax assets and liabilities is true? And we have four statements. The first one reads, a deferred tax asset is classified as non-current only if the company expects the future tax benefit to be received more than 12 months from the balance sheet date. The second option, or the second statement, says all deferred tax assets and liabilities are treated as non-current. The third statement says a deferred tax asset related to a bad debt reserve is classified as current if the related accounts receivable is classified as a current asset. And the last statement says a deferred tax asset relating to inventory capitalization is classified as non-current only if the company uses a FIFO accounting method and the inventory to which the deferred tax asset relates will not be treated as sold within 12 months from the balance sheet date. Okay, we see that the solution is the second statement. All deferred tax assets and liabilities are treated as non-current. Which of the following temporary differences creates a deferred tax liability? 1. Accumulated tax depreciation in excess of book depreciation on a building. The second choice is accumulated tax amortization in excess of book amortization on a customer list. 3. Compensation expensed for book purposes but deferred for tax purposes. And the fourth would be both accumulated tax depreciation in excess of book depreciation on a building and accumulated tax amortization in excess of book amortization on a customer list create a deferred tax liability. And now we see the solution. It's the last one. Both accumulated tax depreciation in excess of book depreciation on a building and accumulated tax amortization in excess of book amortization on a customer list create a deferred tax liability. Compensation expense for book purposes but deferred for tax purposes will create a deferred tax asset. Robinson Company had a net deferred tax liability of $34,068 at the beginning of the year, representing a net taxable temporary difference of $100,200 taxed at 34%. During the year, Robinson reported pre-tax book income of $400,200. Included in the computation were favorable temporary differences of $50,200 and unfavorable temporary differences of $20,100. During the year, Congress reduced the corporate tax rate to 21%. Robinson's deferred income tax expense or benefit from the current year would be a deferred tax benefit of $6,321 or a deferred tax expense of $6,321, these are net amounts, or a net deferred tax benefit of $6,705 or a net deferred tax expense of $6,705. The correct response is a net deferred tax benefit of $6,705. The net deferred tax expense for the current year is $6,321. We take $50,200 less $20,100 and multiply that by 21%. The beginning balance in the deferred tax liability account must be reduced to reflect the decrease in the tax rate by 13 percentage points. So take $100,200 times 13%. That gives you $13,026. The net tax adjustment results in a net deferred tax benefit of $6,705. Tuna Corporation reported pre-tax book income of $1,008,000. During the current year, the net reserve for warranties increased by $29,000. In addition, book depreciation exceeded tax depreciation by $108,000. Finally, Tuna subtracted a dividends received deduction of $19,000 in computing its current year taxable income. book equivalent of taxable income is which of these four numbers? The answer is 989,000, and we get that by taking the $1,008,000 of reported pre-tax book income and subtracting the 19,000 permanent dividend difference, which would be the dividends received deduction. Weaver Company had a net deferred tax liability of $34,170 at the beginning of the year, representing a net taxable temporary difference of $100,500, taxed at 34%. During the year, Weaver reported pre-tax book income of $402,000. Included in the computation were unfavorable temporary differences of $50,500 and favorable temporary differences of $21,000. At the beginning of the year, Congress reduced the corporate tax rate to 21%. Weaver's deferred income tax expense or benefit for the current year would be one of these four numbers, either a net deferred tax benefit of $6,195, or a net deferred tax expense of that same amount, or a net deferred tax benefit of $19,260, or a net deferred tax expense of $19,260. The correct answer is a net deferred tax benefit of $19,260. Okay, we take the net deferred tax benefit for the current year, that's $6,195. How do we come up with that? You take $50,500 and you subtract the $21,000. That difference times 21% gives you the net deferred tax benefit for the current year. The beginning balance in the deferred tax liability account then has to be adjusted downward to reflect the change in the tax rate by 13 percentage points. So take $100,500 times 13%. That comes up to be $13,065. That's a reduction in the deferred tax liability. So the net adjustment is a net deferred tax benefit of $19,260. A company's effective tax rate can best be described as one of the four statements. First statement, the company's cash taxes paid divided by taxable income. The second statement, the company's cash taxes paid divided by net income from continuing operations. The third statement says a company's effective tax rate can best be described as the company's financial statement income tax provision divided by taxable income. And the fourth statement is that the company's financial statement income tax provision divided by net income from continuing operations represents a company's effective tax rate. And now we see the solution. The solution is the company's financial statement income tax provision divided by net income from continuing operations. That's the effective tax rate.